we've got some scenarios. We've got a first scenario which is about the blockchain protocol, and most people kind of get that the really interesting thing here is how we can apply that protocol. So the protocol maturing to the extent that there are no more technology objections. It's sorted. Performance, security, regulation, everything. And then the question is, if you have such a protocol, how can you disrupt banking with it? So at the moment, there are lots of legitimate issues around the technology, not least performance. So imagine it can settle instantly, it's 100% secure, the non-repudiation, everything else, there's the right number, you can maybe even create new coins. It doesn't have to be Bitcoin, it's about the protocol. These, if you work through these worksheets, we'll find out, we'll be able to imagine what would happen if you actually had that protocol. So we'll do it 45 minutes, by the way, and then we'll do a show and tell around each team, and then we'll have a break, then we'll run it on our second scenario. So can I ask you to break out now into 6 groups, perhaps no more than 4 to 6. And the reason Hello. So what we're going to do now, so why don't we start off here with team number 1. If you'd like to gather round. Luke, maybe you can tell us about your findings.
Well, one thing that we thought might be relevant is you wouldn't have any more forgery. Somebody mentioned that in a cash business, there's a lot of, for example, pound coins that come through that are forgery, maybe 1 in 20. That's not an issue anymore with Bitcoin or virtual currencies. That's a simple one to understand, I think. It's a new asset class, similar to other new asset classes that have been created in the recent past. It's something completely new. Banks can use the blockchain maybe to do some of their clearing work that they currently do. So they might create a new type of derivative based upon the blockchain. So we can maybe cut out parties like SWIFT, that wouldn't be as relevant anymore. Banks can maybe have their own currencies like Barclays coin or HSBC coin. So that might be something that we could see rising in the future. But I think banks lend credibility to the new currency, which it doesn't currently have at the moment. So by being involved in the cryptocurrency space, they produce more, or grant more credibility to the whole ecosystem. But we thought of some problems as well, like taxation. How does taxation work? And we thought maybe the blockchain is a way that taxation could be managed, because rather than having a cash system where it's very difficult to trace who has what value, the blockchain can make all of that visible, being a central ledger of all of the transactions that have taken place. So taxation, although it seems like it could be an issue, it might actually be easier to manage taxation in the future. We thought about fractional banking and the way that value is created at the moment when you go into a bank to ask for a mortgage, and the bank account manager presses a button and that's it, £500,000 has just been created. That's no longer possible with the blockchain or with virtual currencies. You can't just create money in the same way. So we wondered if how that would work for the existing banking system. If they want to be involved in virtual currencies or create their own virtual currencies, maybe like a virtual US dollar pegged against the real US or the actual US dollar, how would they create dollars in the same way that they currently do when they grant somebody a mortgage? So we're not really sure how that would work. Yeah.
Okay, Luke, thank you very much. Okay, guys, if we can move on up to the next team. Okay, we ready, guys?
Please prompt me for things I forget. Sorry, yes, hello. So we frankly had great trouble getting over the kind of compliance issues and making the leap of faith that would ever fully be solved. But let's assume we move beyond that for the purpose of the exercise. A few different things. I think we came at it 2 ways. A, on the consumer kind of end user side of it, which is where it started, but we particularly tried to get down into the kind of corporate, macro, global currency basis too. But first on the consumer side, there are kind of 2 directions of adoption. We've got the kind of developed world early adopter techies who are kind of leading the charge at the moment, and there was the big question of how that filters, if it ever does, down into the general economy, out into the merchants that accept it. Perhaps more interesting was for underbanked or unbanked people in the developing world who don't have bank accounts themselves but have their mobile phone or other device, kind of M-Pesa style. Perhaps that would be another route for adoption, opening up all of those kind of types of businesses and services around that. Moving beyond that, we hit on some of the same things about with the banks in developed economies, removal of the SWIFT network, that kind of supplanting existing payment infrastructures, although maybe not, maybe it's just another store of value. We couldn't quite figure out if we were going to call it a commodity or a currency or neither, but another store of value that sits alongside existing stores of value and is traded in and out. Beyond that, then we moved, help me out here if I missed anything on the consumer side, we moved into the kind of bigger world, the more corporate world. So who are the beneficiaries of this? We somewhat cynically wrote the criminals, but we also, and the Cambridge students, like one I employed who funded their drugs for the entire degree on the basis of Bitcoin's increase in value, never having to pay again. But then more seriously, this whole issue of a global economy, there were some comments about if you can get to the stage of it being a true kind of world-class store of value, you end up with all kinds of weird impacts from emerging markets desks in investment banks becoming fairly irrelevant because A, there's a common currency, B, there's a lot less complexity, a lot less human work needed on that side. We also actually came up with a wonderful conclusion that the US will go bankrupt. As in, should the US dollar get supplanted as, world's reserve currency by a Bitcoin or a like, you end up, sorry, there's some comments in the room here. Okay, so we're ahead of the curve then. US fundamentally could go bankrupt because it couldn't service its US dollar debt, et cetera, et cetera.
And you can't cut anyone out of the global economy like the US has done to Iran and North Korea.
Sorry, yeah, sanctions don't work, basically. Anything I missed there, guys? I think
we said that the banks might have to look into alternative revenue generating models like wallet services, because obviously their transfer fees are going down, and also there's a reduced activity in hedging, because of course you could actually, what we said before, the more unstable currencies, we could actually get rid of them and actually just use Bitcoin instead if possible. And then that was it, really. Oh, the other thing being that there's an issue with, because you can't control the supply, it's that has some interesting...
But whether that's an issue is another...
Well,
debate about this.
yeah, okay.
We need to move through, okay.
Yeah.
Right, brilliant. Okay, William, thank you very much. William and team, thank you very much. So, team 3.
We covered a number of the points that have been raised already, so I don't want to kind of go repeating the overall thing and try and summarize our overall theme. But I want to pick out one or two points that maybe haven't cropped up before or we emphasized. The first question, just starting off with the kind of cynical plus ça change, plus c'est la même chose. How does life change, or what does this scenario look like? One of the points that we were making was that it doesn't change. Babies are still born, people get married, they get divorced, they buy houses, they have jobs. Life will go on almost identically in the future. And so I think the point here is disruption is a phase. Yeah. So we fast forward to 10 years' time, and one of the angles we were talking about was in terms of the blockchain protocol, is that, of course, all assets, not just currency, can be in the blockchain protocol. So you imagine in 10, 20 years' time, equity's there, gold's there, your driving license is there, your ownership of your car's there, all the property's there. There's been a massive period of disruption, and then everything calms down again. Because, as I say, we just get born, we die, we get married, we get divorced, and all that kind of thing. So that's really looking at disruptions that change. A lot of these have been picked up before the governments. The trust was something that we were talking about quite a lot. We decided we were going to be sponsored by Elliptic, so we look forward to our free coffees later for the free advert. But trust is really a big thing, because the blockchain protocol is a technical protocol, just like how you use a telegraph wire has a technical protocol. But this is always situated again in a social context and a societal context. And in a societal context, institutions aren't going to go away. You're always going to have the institutions, which are groups of human beings who've got a certain function, which need to happen in parallel with the technical protocols. So in terms of winners, we thought, hopefully accurately and not too cynically, that lawyers are going to be one of the beneficiaries. Because you're still going to need some kind of legal framework around transferring every asset you own, cars, equity, gold, property. Regulators, of course, they always win. They'll go on their mission creep and gradually include things. Early adopters, we thought, and in particular, trust creators. We were talking about the angle that a lot of people in the tech world, a lot of people here, are very kind of, quotes, professional. They're very close to what's going on. They understand it really well. They'll kind of do it for themselves. But the man on the Clapham omnibus who wants to buy a few Bitcoin might well be prepared to pay a fee to some organisation, for example, James's, who will go and insure it at Lloyd's so it won't go wrong and he doesn't have to worry about it. It's like an insurance policy. So trust creators, we're talking about a big thing. And then number 6, what other implications does the scenario hold? Well, one of the points we came up with was really going back to the beginning, which is that can 100% trust exist? So at the moment, I don't necessarily trust sterling. Over my lifetime, the value of sterling against all European currencies has gone down. Foreign holidays have kept going up. But I have no alternative. The government has this monopoly, so I have to trust it. Equally, in Europe, the politicians are mortgaging our great-grandchildren's future on their vanity project called the euro, but there is no alternative. In these digital things, there is always an alternative. So really, we're kind of questioning whether we'll get to the 100% trust. Have I missed anything out, guys? Do you want to add any points there? James?
Just on that trust as well, we were talking about how if everything's represented on a blockchain, it becomes much easier than it ever has been before to steal things of high value from people. Because at the moment, you can't just go and steal someone's wealth, because that's represented in all sorts of ways and all sorts of very hard to change asset registers. Whereas if you have this digital asset register, it makes it much easier to steal that ownership.
Okay, thank you very much for that, guys. Okay, so let's move over here to team number 4.
Okay, so we only got through the first 2 formally, but I think we touched on a lot of the other points as well. So we talked about how the blockchain can replace the global clearing system, and it can do it either sort of in a wholesale manner or as a parallel system, and the result would be a clearing system that looks a lot like the internet. So that's to say that it's instant, it's far cheaper to the point where we'd almost call it near free, and the barrier to entry, because it's networked rather than centralized, would be far lower. And by implication, as the barrier to entry is lower, the economies of scale that you see in banking might not be as pronounced for a clearing system. And then more broadly, looking at other applications, so we were picturing this, and again, this kind of follows on from this lower barrier to entry. We're imagining an ecosystem of various decentralized projects. So they could be political, they could be economic, they could be media-related. So the first one is currencies, I mean, obviously there's already a very rich ecosystem of alternative currencies that use the Bitcoin protocol or a derivative. We would imagine that we would see currencies related to corporate brands, currencies related to particular communities, currencies encoded with particular political or monetary understandings in them. We would see, as you're describing, legal implications. So the blockchain, as most people probably know, that you can't remove anything. You can't remove anything from the history of the blockchain. So this has great applications in contracts, but also has more interesting and maybe problematic implications for media platforms where. And so Twister is the example we were describing, which is a modeled on Twitter, except that no tweet is deletable. So that's the idea. And then in terms of the impact on banking, one of the things we were pondering was that banking becomes almost more optional. Suddenly, having all your cash under the sort of digital mattress becomes an option again in a way that it wasn't necessarily. It's not really viable at the moment. And that might raise expectations of the kinds of services people are getting from retail banks. And people were describing kind of wallet services and new types of security, and we were also talking about the speed of transactions that people would expect, and also the ability to make cross-border transactions. So right now, I wouldn't expect to be able to transfer money to Nairobi quickly and cheaply, whereas that would likely change. Was there anything else that we touched on from the team, guys? Okay, that's it.
Okay, thank you very much. Okay, last group.
Okay, so we probably kind of got a bit of duplication, obviously. But kind of at the top of the list, we kind of thought about new value exchange models, new forms of currency. Some of the discussion in the group was around gaming, say synthetic currencies, like Warcraft and things like that, emerging. We kind of move on to like the economic models. So really, if you are replacing the mechanism for value exchange, then apart from gaming, Facebook issued a Bitcoin currency. It's 1 billion people. Could be quite interesting in terms of the economic models that would arise. So you could potentially get new forms of sharing. Different sorts of mechanisms, the way that non-nation states type currencies would emerge. We thought e-commerce was interesting. We kind of talked about Amazon and their Amazon Points, I believe it's called. Amazon's obviously a very large e-commerce platform. If they issued their own currency, that might actually change some of the supply chain type models and things like that. So big, disruptive impact there. We believe that Western markets are probably more advanced and will probably be a laggard in terms of the adoption of Bitcoin. We see it very much for the unbanked, so the 3 billion people in the world who don't necessarily have bank accounts, and I think that echoes some of the other comments from other presenters. We kind of focus on the positive aspects, so we think it would reduce corruption because obviously accountability. We also think the increased ability to regulate and potentially raise taxes. So a lot of the emerging markets don't pay taxes or aren't collected in a very specific way. And then also we think this, if it was done correctly, would increase security and potentially increase stability of some of the countries because it would be more accountable. Less violence because people with physical cash are more susceptible to robbery and things like that. We thought one of the maybe negative effects could be the undermining of reduced governmental control, because if you can transfer value, money, currency across border, then the nation state or the concept of the nation potentially changes. We think better, cheaper international payments. I think that was echoed by some of the other guys. We talked quite a bit about smart transactions. So obviously the blockchain allows you to implement a form of a smart protocol, smart contracts. Obviously, escrow functions, maybe trade finance and things like that, or even more kind of complex conditional transactions could create very interesting kind of value exchange models. We had a really good discussion around peer-to-peer lending, and one of the participants from Wonga, you might want to say something in a minute. But in fact, if you think about it, you could potentially encode a contract in the peer-to-peer lending currency. So, in terms of peer-to-peer lending, it may well have an impact. And then lastly, we talked about availability. A lot of the existing banking models, especially core banking systems within banking money transfer systems, are not available 24/7. Obviously, Bitcoin is a 24/7 type model. Does anyone want to add anything or from the group?
Looks like you got it, Thomas. Thank you very much.